This video provides some additional practice on some of the exercises in Chapter 3. And these were two exercises that were covered for those students who attended class last week. One is exercise 3-1, and this is found at the end of Chapter 3. And in this exercise, we have the December 31st, 2021 year-end account balance information for Stonebridge Corporation, and they give the balances of a variety of accounts. And I reproduced those here. They did not give us the short-term investments, however, and the only liabilities not listed are a $30,000 note payable due in 2 years and related accrued interest of $1,000 due in 4 months. The current ratio at the end of the year is 1.5 to 1, so what that means is that the current assets are 150% of current liabilities. Alright, so I got the information down. I did change the data a little bit for those who would like to do this problem themselves. So I have the salaries payable at $20,000, and in the problem they're listed at 15. So I did change that. Otherwise everything else is the same. So I have a series of steps that I use to resolve this exercise, and step 1 is to determine the current liabilities. And the current liabilities in this case are going to be the addition of accounts payable, salaries payable, and the interest payable. The next step was to determine the current assets of $95,700, and here I'm going to take the current liabilities and multiply it by 150% because that's our ratio. So if the assets are 150% of 65,000, that would give $97,500. So now we have our current liabilities and our current assets. The next step is to determine the short-term investments. Well, if we're given our total current assets, and we're given all of the other current assets except the short-term investments, then we can just deduct all of those current assets that we know about from the total of $97,500, and that will give us the short-term investments, in this case of $12,500. All right, and the step 4 was to determine the total assets. So here I'm just going to add together the property, plant, and equipment of $120,000 plus the total current assets, which we already solved, and that gives $217,500 using my numbers. And finally, step 5 is to determine retained earnings. And there's a note here that I have that please remember that retained earnings is just one component of stockholders' equity. If they give us, for example, the paid-in capital of $100,000, and we can then determine total equity and then simply deduct the paid-in capital of $100,000. So we can take our assets minus our liabilities and then deduct the one component of equity, which is paid-in capital, and that leaves the other component of equity, which is retained earnings. So assets minus all the liabilities, less the paid-in capital, gives us the retained earnings, which is the second component of equity. Over to exercise 3-19. In this exercise, we have the current asset section of Guardian's consultant balance sheet, which consists of the list of accounts that I have here. They do not give us the accounts receivable, so I'll have to solve for that. The stockholders' equity I have changed. In the problem it's $2.5 million, and I changed it to $2.95 million. Otherwise everything else is the same. Current assets are 2 times current liabilities, or 200%, and the debt-to-equity ratio is 140%. So using my sequence of steps, first thing I did was determine the total debt or liabilities. And the total liabilities then, using my values here, was to take the debt-to-equity ratio, 140%, and multiply it by my shareholders' equity of $2.95 million. Because we know that if debt is 140% of equity, and we're given equity at $2.95 million, then 140% of that is $4,130,000. Step 2, determine total assets. In this step, I just added together the I took the shareholders' equity and I added to it the total liabilities, because we know that assets equals liabilities plus equity. So it's just a matter then of adding together the shareholders' equity and all the liabilities that we just solved for. And that, in a balanced situation, a balanced financial statement, gives $7,080,000 using my numbers. On to step 3, determine accounts receivable. Accounts receivable in this case was I took the total assets, that was my starting point, and then I started subtracting long-term assets, and I subtracted prepaid and cash. And once I subtracted all of those, the only thing left was accounts receivable, which is $3,020,000. In step 4, I determined the total current assets. Well, since I have all the current assets now, I've solved for the accounts receivable, I can just add together then my accounts receivable plus the cash and the prepaid expenses. And that gives me my total current assets. Over down to current liabilities. To calculate the current liabilities, I just took the total of current assets using the current ratio, and the current ratio is the total of current assets times 1 over 200%. Because if current assets are 200% of current liabilities, then current liabilities would be 0.5 or 50% of the current assets. Because 1 over 200% is 50%. So I took 50% of the current assets, and I now know the current liabilities to be $2,340,000 using my numbers. And then next we determine the long-term liabilities, and now that we have the total current liabilities, I just added together I took the total current assets and then I deducted the total current liabilities, and then I also deducted the shareholders' equity. And that leaves me with the long-term liabilities, again referring back to our assets equals liabilities plus equity, or liabilities equals assets minus equity. And that's kind of the formula I used in this equation. For step 6, I started with the total assets, and then I deducted what I knew, which was the current liabilities, and then I also deducted the shareholders' equity. And the only thing left would have been the long-term liabilities. Finally, the asset test, or the quick ratio. Here I took the total of current assets, and I deducted from it the prepaid expenses, and I divided by the total of current liabilities, and that gives me the quick ratio. Remember that we do not include the prepaid expenses in the quick ratio. It's not a quick asset. Otherwise, we just would take the current assets less the prepaid and divide it into the current liabilities. If you have any questions on either of these two exercises, please let me know.